Good day. I don't think it is a secret that the last 6 months was a very tough period for financial markets, but indeed for the world. If we turn back the clock a year, nobody would have expected inflation to be at over 8% in the US, over 8% in Europe, and approaching 8% in South Africa, particularly since the Fed targeted an inflation rate of 2% about 18 months ago. On top of that, as a result of these higher inflation numbers, we either had interest rates being hiked by the central bankers, or we have the threat that interest rates might go up. And in fact, in Europe, we haven't seen an interest rate hike since 2011. So we sit with higher interest rates, the threat of higher interest rates. We sit with higher energy prices, with the Brent oil price now trading above $100. And of course, we also sit with a war between the Russia Federation and the Ukraine that, of course, is a threat to the existing world order as we know it. And finally, as a result of these high interest rates, we can clearly see that economic growth rate is starting to lose momentum, and there's a risk that the growth rate can go into negative territory, or as we say in economic terms, that the world growth can go into recession, with the risk being Europe in particular, but also the US. So against that background, I don't think it is a surprise that we've seen that in terms of financial market performance, there was absolutely nowhere to hide. Equities in general came down by about 20% in dollar terms. And if you break it down into the different markets, growth assets in particular, or growth shares in particular, came down significantly, with the NASDAQ index, which is the information technology index in the United States, losing 30% on a year-to-date basis. The S&P 500, which is an indication of equity prices in general, that was down 20% because I think the assets in South Africa were not as expensive as in the overseas markets. South African equities only lost 9% or 8.9% over the 6-month period. So at least the carnage was not as extensive in South Africa as we've seen it in the rest of the world. Now, what you would normally find that in a period when equity markets come under severe pressure, that fixed interest markets or government bonds provide a buffer against this fall in asset prices. In the 6 months period that we're talking about, that certainly didn't happen. And because interest rates were so low, and because inflation started to pick up and surprised on the upside, bond yields had to respond to that. And over the last 6 months, long bond yields in the United States went up by 150 basis points to over 300 basis points for this particular period. The net result of that was a 10% decline in capital value if you were invested in a so-called safe haven called global government bonds. The only area to hide over the 6 months period was an investment in energy or energy-related stocks. The oil price, as I've mentioned, increased to over $105 per barrel. And what we've also seen is that energy-related listed equities also performed very well, obviously as a result of the high oil price. So that was really the 6-month period. What is more important now for us, of course, is to say, where are we going from this particular point? Because at least the one thing that we do know is that asset prices are down significantly from where they were 6 months ago. Most of the analysts know about the problems that we've seen in the world, and therefore one can clearly argue that the bad news must be priced into financial assets. Well, although we normally argue that we can't forecast the future, I think it is quite important that at least that we should express our view in terms of the potential outcome of economic activity going forward. And I think one can easily argue for at least 3 different scenarios if we look forward over the next year to 18 months. The one is, firstly, that the Federal Reserve is successful in curbing inflation by pushing interest rates up, but without pushing global or economic activity into recession territory. So that is what we would call the scenario of a soft landing, slower growth, but for the US economy not to go into recession. So that is one scenario. We think that that would be very difficult to achieve, And there's normally one indicator that is a reliable indicator of US recessions, and that is the slope of the yield curve. And the slope of the yield curve has gone into negative territory. And if you look at the last 3 cycles, when the slope of the yield curve went into negative territory, unfortunately, it was a good leading indicator for a US recession. So we don't attach a high probability to it, but maybe this time the Fed is lucky and they can navigate through a soft landing. The second scenario is one where the Fed is not that lucky, that the high interest rates that the market perceived to come through in the next few months, that will ultimately act as a brake on economic activity, that momentum will fizzle out, and that the US economy will ultimately end up in a recession. Now, just as a definition, a recession is 2 consecutive quarters of negative growth. And just remember that we've already had 1 negative quarter in the first quarter, although we don't think it's base case that the second quarter 2022 will be negative. We think it's rather likely that the US economy might fizzle down into a recession late in 2023. Then there's a third scenario, and that is a scenario of high inflation and low economic growth, but not negative economic growth. We talk about stagflation in this case. That is quite dangerous because it does mean with high inflation that consumer spending will come under pressure, and ultimately that the central bankers can't ignore it, and they might well then be brave enough to hike interest rates high enough that will ultimately cause a recession. So you can clearly see that you can make 3 different arguments, and what is important for us is that for each specific scenario, there is normally an asset set that is the correct set that will bring an investment outcome that will benefit client portfolios. But it is not an all-fits-all kind of scenario. Now, if you're not sure about the 3 particular outcomes and you think that there's a probability that you might have any one of those 3, then I think all of you would agree that one needs to diversify when you think about portfolio construction for client portfolios. Now, what does diversify mean? Over the last 30 years, it probably means that one needs to employ equities, a combination of equities and fixed interest assets in a portfolio, because those 2 asset classes were uncorrelated. In other words, they didn't move in the same direction under a particular set of economic circumstances. However, if you go back to the 1970s, what we've unfortunately seen, and that was a period of stagflation, that those 2 asset classes were indeed correlated. In other words, they moved in the same direction. So they didn't provide you the same protection against a particular economic outcome. Hence, when we talk about diversification today, we think that you need to include other asset classes as well. What are those asset classes? Well, you can think about commodities. Maybe you should have energy in your portfolio. Now, if you're a South African, of course, we would have exposure to Sasol in the portfolio, but we should also think about global energy exposure in our portfolios, because, by the way, that is one of the reasons why we sit with high inflation. The other asset class that you should think about is inflation-linked bonds. If inflation indeed proves to be more stubborn than what we think it should be, then those inflation-linked bonds will provide a wonderful hedge against inflation. And then, of course, there are also different hedge funds that you can employ in portfolios to provide you the diversification that one deserves in very uncertain times where we are today. Does it mean that we need to sell off more equities? If one looks at what we have done over the last year, you would probably recall that we have said that global equities in particular was quite expensive. So over the last year, we've already taken some beta off the table. What does that mean? It simply means that we sold global equities out of the portfolios to reduce the risk to high valuations that we spoke about and to the uncertainty as far as the macro outlook is concerned. Given the decline in equity prices, we are very hesitant to trim equities further because we've already created the spare capacity to invest in those other asset classes that we spoke about. At these levels, we are very hesitant sellers of equities, and we are unlikely to trim further at these levels. However, should we see a significant recovery in equities, we might reconsider that. The other point is also, should equities fall further, we do have cash in the portfolios, we do have exposure to commodities in the portfolios. We can always trim that and use that as the currency to buy equities to ultimately position the portfolios where we buy cheap assets and hopefully at the right time when the cycle does recover, that our clients get the benefit of that. But to summarize, the outlook is quite uncertain, despite the fact that prices have fallen, but we still don't think it is a time to take on significant risk in portfolios, and we believe that a properly diversified portfolio will provide the outcome in terms of returns, but also protecting against potential further sell-offs in the portfolios that we manage for our clients.